we now have a panel with esteemed colleagues working on sustainable finance in a number of financial institutions. And we want to kind of explore some of these themes in more detail. We've got 3 panelists, and it's one of the reasons why I took the liberty of not cutting off Helena too quickly. But that said, we've got Anne-Claire Ducrocq, who's the head of ESG reporting at BNP Paribas, Julia Dieckmann, head of sustainable finance policy at Deutsche Bank, and we've got Sean MacHale, the financial services partner for climate change advisory and sustainability services at Ernst & Young, and therefore can bring also a broader perspective to some of the other financial sectors and the work of smaller financial institutions. So I think we've got an excellent group here of experts. And maybe if I start, I would like to kind of explore over the next 50 minutes or so 3 main themes with the 3 of you. One is the type of challenges you face in your own work, because we heard about the challenges among the corporates, but of course it doesn't end there. And we've already had some conversations about the link between the SFDR and the corporate reporting framework. How you look at usability and how the concept of usability has evolved over the last few years. In a way, Helena's example, are you finding that you get in the Microsoft packages, or are you still kind of on BASIC and COBOL and trying to program everything yourself if you listen to the beginning of her intervention? And thirdly, are we already seeing first decisions within your institutions that are driving, or your clients' institutions, which are building in, let's say, discounts, advantages, what we call the green dividend, into lending activities, into investment activities? With that, maybe I start with an open question to you, all 3 of you. How do you feel the EU disclosure framework is working for the financial service industry, the non-financial reporting framework? Do you think that's working smoothly? Where do you see the gaps? Maybe I start with you, Julia.
Thank you, Nick. Thank you for inviting me to this panel. I think before we start getting into the challenges with the existing framework, and we have heard a lot already this morning from the corporates, I think we also need to acknowledge that the EU has created a role model regulatory landscape, which globally set many impulses. We see all of these taxonomies coming up. And at the same time, really the sustainable finance markets have grown tremendously. If you look at sustainable bonds, for example, they have quadrupled over the last few years. And we have been provided with this sort of science-based framework with the taxonomy, which defines what is green and sustainable. At the same time, achieving the alignment with the high bars the taxonomy is setting is challenging for the corporates. And we, of course, have to rely on the data from the corporates. And I think if you look at the sort of recent reporting cycles, Eurostoxx 50 companies, only close to 3% have achieved compliance or alignment with the taxonomy, looking at turnover data. So I think, and this was also flagged by some of the corporates this morning, at the moment, the EU taxonomy is not yet a steering tool, but rather a compliance exercise, both for banks and corporates, and it's of course resource intensive. But I think it's too early to sort of make a final judgment, and we will have to see how the taxonomy will develop over the next years. At the same time, the banking sector, of course, committed via the Net Zero Banking Alliance, for example, already to net zero targets, and Deutsche Bank was one of the founding members. So we have given ourselves clear targets, and this commitment really had transformative character on the company. So we are focusing on certain sectors, and we have already reduced high emitting sectors, for example, oil and gas, by close to 30% during the last year. So what I want to say, the banks have not yet reported the green asset ratio. This comes next year once we have the data from the client scene. But even a low taxonomy alignment at the moment does not really say a lot how fast a corporate or a bank is transforming already. So I think we need to sort of widen the view and focus more also on transition plans and transition pathways, think beyond green, look at the activities and the corporates which are not yet considered as completely green as of today, but which have the potential to transform and which need financing from our side.
It's interesting, you're already picking on a few things that we just discussed with Helena, the importance of credible transition plans. But Anne-Claire, maybe the same question to you.
Yes, first of all, Nick, thank you for inviting me in this conference. I think I totally share what Julia was mentioning, that we are facing a very sharp acceleration of the regulatory agenda, which I would say is welcome, because I truly believe that the disclosure, for instance, regulatory framework is what we need, is what we bring and build a confidence climate between corporates, regulator and financial investor. So on this part, I totally support, and we totally support this calendar, this EU calendar, even if the acceleration is quite sharp and probably the order has not been always the wisest one. But for sure, what is also challenging from our point of view is that, as Julia mentioned, it's not like if we started from scratch. So we have already done taken our own commitments, adapt our own targets, and now what we need is to, I would say, make the link between how we are going to switch from an in-house monitoring system to a compliance exercise from to the regulatory framework, and bring them together in the future. So I think we are not yet there. We are not able yet to monitor everything based on the EU regulatory sustainable framework, but we are working on it, definitely. I think Elena was mentioning first the precautionary principle that everybody is applying now. I think we are totally here. For instance, on the EU taxonomy, we can see from the first exercise on eligibility that the eligibility ratio of the banks are still driven by the loans granted to individuals. So we acknowledge that the reporting is still not a totally deployed instruments at corporate level for the difficulties that were discussed this morning, for instance. So we still don't have the data. We still don't have the common methodology, the shared methodology. For instance, for the transition plan, we have net zero banking alliance methodology, but they need to converge with regulatory expectation. So I think it is very important to understand where we are. It is too early, as Julia was mentioning, to have a conclusion. But if we all work in the same direction, and especially if we are able to take to listen to the main takeaways that will bring on the table this first exercise altogether, I think we are on a good pathway. But it is very important that we make the regulator can have our feedbacks to better understand what we are actually facing. And this data issue is not only on the taxonomy. You can see it on many other issues. For instance, the GHG emission, for which most of the banks only don't have more than 20% of their portfolio that are covered. And for some other data, very important for the individual and for the mortgage loans, like energy performance certificates, that are not homogeneous and are not yet there. So, well, the message would be the sharp acceleration was probably needed to start working on the same direction, but now we need to test it and to take the time to have the good conclusion and have a calendar that is more usable to promote usability.
Thank you very much indeed, and clear. Two things before I pass on. One is just to remind the audience again that we have the Q&A function, and you're very much welcome to ask questions directly to this panel or just on any of the themes that we've discussed so far or are discussing today. Before I come to you, Sean, allow me to just ask two follow-up questions to both Julia and Anne-Claire, and I think you obviously as well when you come to it. So two things I've taken away so far from the comments is, A, that we still are challenged about the data availability. It always comes up in our sustainability finance discussions. So to what extent is the completion of the ESRS and the work that's going on by the ISSB and EFRAG contributing to you getting that data? How confident are you, particularly in the light of the current Commission consultation on the Delegated Act, that that is bringing you in the right direction? And the second one is, if I paraphrase, I don't think you said it quite as clearly as this, but you're challenged also still by all these different frameworks that are coming through. You have compliance under the SFDR, compliance as a corporate yourself. You've got your own international commitments. You've got international standards, different requirements in different jurisdictions, Pillar 3 disclosure requirements, supervisory requirements, stress testing, the list goes on. How do you see those different pieces come together? Is it basically all different initiatives pushing you in the same direction? Is it coherent? Is it incoherent? How is it influencing your ability to achieve effectively what you want to achieve, which is to steer finance into more sustainable and climate-friendly activities? Maybe Julia, first to you.
Yeah, maybe let me start with your second questions on the sort of complexity of the current framework. I think there are no sort of targets conflicts at the moment, but as I said earlier, I think it is more the focus on or limitations of the framework, because it is focusing on what is green, and we would like to look beyond and focus more and provide financing to activities which can improve the environmental performance. And so it's very important to look at what's going on at international level with regard to transition finance. And we have seen Japan coming out with guidelines here. And I think what is sort of important is that they start to provide definitions for transition finance, and at the same time looking at the sectors, providing sectoral pathways for hard abating sectors, for example. And here we see within Europe now the Corporate Sustainability Due Diligence Directive coming up, making transition plans mandatory in the future for corporates. The CSRD comes from the reporting angle, asking to report corporates on the transition plans. I think all of this is very important, but of course, for international institutions like us, this needs to be ideally globally aligned, and we need a harmonized approach and a clear definition to be able to sort of further upscale the transition financing.
And Claire?
Yes, maybe to start with your first question, I think the work that have been performed with the ESRS and the CSRD is obviously a very important first step in the process of getting the data. And obviously it is a huge transformation, because there is a lot to do there. So it's very important that we are provided with an open database with all these very useful data that we are integrating in our business process. It's not only reporting, and it is reporting transparency, but for us, it's also how we are going to monitor and reorient our capital flows. So this first way of collecting data is very important, and this is something we strongly support. After, what is very important also to understand is that, as Julia was mentioning, first of all, we are not only European banks, so we clearly need not only interoperability between norms, but also a real level playing field on this issue. So this is why we are strongly supporting, for instance, ISSB works and all the other work that are performed in other jurisdictions to try to align with the taxonomy or sustainability reporting initiatives. So this is the first thing, and there is also something which is very important to understand, is that probably it might be a difference with asset manager, but we at bank, we are also we have this capacity to fund project assets. So I think that we need to bear in mind that this for sure ESRS will help, for sure ESRS, CSRD taxonomy and all the initiatives that will reinforce transition plan will help. But we'll need also to keep our link with the client itself. And this is what we are doing at banks, and identifying at assets or entity or project level these projects that are enabling the transition. So we just have to keep in mind that it is not the only way to collect information, and that when the regulation are performed, they should also take this into consideration, that we need this, and this is very related to your second point. There is a lot of initiatives, as you were mentioning, because we are working to adapt our monitoring tool at this level of granularity, and this is not that obvious. So, as you were mentioning, at the end, the work that we have and the challenge we are facing now is try to reconcile all this initiative at the very good, and try to see which data and which information are really key for banks, and that can help us not only to be able to perform stress testing, but also issuer analysis, issuer rating, or issuer ESG rating, but also identifying green or transition project at corporate level. So we are there, and we are working very fast, I would say. At least I used to develop a lot of regulatory reporting in the bank, and it is probably the most challenging because the wider and the faster one. So I think we are there now. Yeah.
What you've just said captures an interesting question we had from the corporate panel at the end, which is they feel they report a lot, but they don't know how much of what they report is really useful for you. So is the flow kind of effective and consistent? But Sean, you've been very patient, or made you very patient. I think you engage with a lot of financial institutions across the different sectors, and you've been listening to this from the kind of in-house perspective. I'd be interested how that matches with the work that and the feedback that you're seeing from your clients.
Sure, I think it's very, very consistent to what we hear across all financial services, whether it be banks, asset managers, insurers, or indeed private equity. I think the first thing maybe to point out is that there's been huge progress made. It's only 4 to 5 years ago that, in earnest, this journey started in terms of the EU Green Deal. And effectively, what we're looking at in essence is rewiring the financial system, and that takes time. And I think then from perhaps a bank's perspective, really, the starting point was meeting that regulatory expectation, whether it's driven from the ECB or other regulators, and then looking at one's own operations, target setting, as Julia had mentioned, looking then at the whole area of reporting disclosures, as Anne touched on, And of course, we've seen a huge amount of progress in the last number of years on that front, whether it be under your Article 8 under taxonomy, looking at your Pillar 3 disclosures, which started for last year, reporting this year. And again, it's given us really good insights to the progress that banks are making. I think the next key part is moving to commercialization. And so it's essential that we start to transition the economy. And I believe it was Julia who mentioned around the definition piece. Absolutely, that has to be resolved, and it has to be resolved in the short term, because there's many impediments. But, you know, I suppose maybe to take it up a level, when I speak to clients, and to summarize it, what clients want is certainty, clarity, consistency, and compatibility. So again, if we can deliver on the 4 C's, I think then that you'll see the finance flow in a much freer way into those areas and that need financing, and maybe more importantly to those areas that desperately need to transition to hit the targets that have been set, both in terms of the Paris Climate Agreement and also at the EU level. But from a client's perspective, we see a lot of progress. We also equally see the challenges, but a lot of these challenges are surmountable. But again, we have to work very, very closely with the regulatory authorities to bring those 4 C's into play, to ensure that finance is going in the right direction, and of course making sure that the timelines and the sequencing is done in the correct order, because again, that can create friction within the system. I do think CSRD will bring things on quite a bit. I think it's interesting to note the crossover in terms of the PAI data points in that. So again, I think in time it will become the single source of truth, and maybe that will alleviate some of the reporting considerations at the corporate level. But I do think it's important that both corporates and financial services engage with it, and they build it out maybe slightly quicker than the timelines allow, or indeed maybe take on board more of the voluntary disclosure requirements earlier in the journey to try and expedite the exercise.
I think you touched on a good point that I always see in the sustainable finance debate, and I'm not criticizing any policymakers, but normally in any project you start with a plan and then you build the foundations and you put the walls around it, and then you kind of think about the finishes at the end. Here I feel they bring in all the workmen at the same time without a full plan. And so you've got the chimney, you've got the fridge, you've got one window and half a wall, and the rest you have to kind of work out in time. So the reality is sequencing isn't working the way it should. The pieces will be all there, but they're not all there in a sequence that they build on each other. So while I like your concept of the 4 C's, I think we need a few years before we get to the 4 C's. So how do we deal with the reality that we're in at the moment? So how are you looking at that in helping financial institutions during that transition until we get to that, let's say, more perfect semi-stable state?
Sure. So I think we do it on a number of fronts. I suppose the first thing is that we're really looking at is where do we need to deploy capital, how we're deploying that capital, what information do we need to be able to deploy it in a robust way, and how that helps then in terms of the overall journey. So I think, you know, perfection is the enemy of good. I absolutely agree. It's a smorgasbord at the minute in terms of how some of the regulations are laid out, but I don't think that's a good enough reason not to start. And I think in a lot of respects, privately, the Commission and the EU expect financial services to be able to figure it out. So we spend a lot of time working with clients, helping them in terms of that transition pathway, helping them from a scope 3 perspective in terms of mapping that out against the high priority portfolios. And again, we've seen good work there, and it has to be said. We see a lot of banking clients now introducing transition plans. So they're asking clients for transition plans so they can factor that in to make sure that it's aligned with their own internal targets for scope 3. So I think we're seeing progress already, maybe in the absence, or to put it another way, with the existing constraints, as you mentioned, around sequencing. But again, I think as the commercial opportunity becomes more apparent, and if you look at the numbers, they've gone from billions to trillions, I think you're going to see financial services starting to run a lot harder, because, you know, this is about doing good business with good clients. And also I think there's an expectation there from customers to help them on the transition. And again, who are they going to look for that help? Financial services is going to be one of the key players there.
Thank you. Maybe coming back to you, Julia and Claire, and speaking to Helena, we touched on transition plans and the importance of transition plans just now on this panel. When I spoke to Helena, she very much not only, but very much focuses on CapEx. So it's not to measure transition, it's about the investments that companies are currently making to get them to a greener space. When you, I mean, we're still at the early stage of transition planning, but you said it was an important tool for you in assessing where corporates are in the journey. And so I'd love to explore a little bit more how much focus you put on your own transition plans, as Sean just said, but on your clients' transition plans. And to the extent that it's possible to say at this point, what are the type of criteria you take into consideration when looking at those transition plans? Is CapEx a key one? Is it about the length of the rollout, the type of criteria that you might be considering? Maybe Anne-Claire, start with you because I start with Julia the last two rounds.
Yes, actually, it is a very good question. As for now, we did not really have, let's start with the beginning. As I would say that before CSSD and CSRD, we did not have a very practical definition, and we still don't have a totally practical definition of what actually is a transition plan. So the way we are dealing with it today at BNP Paribas is that, first of all, we had, I would say, we had this strategic plan in which we are supporting the funding of sustainable activity. And to do that, we have, I would say, defined our whole taxonomy, our whole criteria, encompassing climate change and climate adaptation, of course, but also all other environmental and social objectives. And what we try to do is to embed what is already defined by the regulation, part of this classification principle. So for instance, we strongly rely on taxonomy criteria to identify deals, I would say dark green deals already arrived at the target in this framework. But we had also defined our own criteria to define what is transition. And what is very important for us is to have a good insight in this transition pathway on, first of all, potential risk. Of course, this is very important. This is, I would say, the first step, knowing what are we have some surveillance, I would say surveillance criteria, make sure that there is make sure that we have the sufficient confidence level in the transition plan, share with the corporate. And on this part, I strongly support what Helena said, knowing that if, for instance, a company is active in a sector that is supposed to contribute to climate change, and this company does not have any aligned turnover or CapEx, or doesn't have any transition plan, I would say this is the first information that a bank would definitely look at. So first of all, you have this kind of surveillance criteria. Do we have confidence on what is disclosed? And in that field, CSRD and CSDDD will bring confidence for sure. And after, we are going to look, if we take the climate, but it's true for any other objective we support, we will have to look at the way it is monitored so what are the policies, what are the policies, what are the targets, does the firm have set targets, and how they are progressing on it, if there are already a monitoring and a performance that is measurable on it. So this is from a very, this is a perspective at the corporate level. But of course, we are also having a portfolio level analysis. And this is where we have our commitments. And on this, because the idea is to be aligned at portfolio level and not only supporting one corporate or the other. So these net zero commitments are at portfolio level. And on this part, we are definitely needs, and to answer the question we were raising, we need harmonized data. And typically we will need data that are supported by the ESRS, for instance, sectorial ESRS in the future, like intensity. We need to have this assessments towards EU taxonomy alignment. We need, on this part, as Julia was mentioning, we need an harmonized definition of the transition so that we can provide reporting at portfolio level, at aggregated level. This is very key to support, for the regulator to bring us KPIs that can be aggregated at portfolio level. And just, I would last time emphasize the fact that it's working quite well on the EU level, but what we definitely need also is that we start to at Europe level to build a level playing field, meaning we try to engage also our international stakeholders so that we are not, so that we can have the same information from our non-European clients, at least the minimum ones.
Thank you, very clear. So very helpful more on the entity-based assessment. It's a good proxy whether or not there's a transition plan or not, but much more challenging when it comes to the portfolio level, if I were to summarize a little bit. But Julia, over to you. How are you looking at that?
Yeah, no, thank you. At Deutsche Bank, we have also a sort of sustainable finance framework, which is built on or is reflecting the EU taxonomy, but also goes beyond, as we have a global approach and also include, for example, social bonds in this. So we take the taxonomy criteria, but in the future, when we will also think about transition plans, I think what we need here is sort of common understanding. And I think here the regulator can support in terms of what is a credible transition plan, because as you said, there are sort of many definitions out, and from our point of view, a credible transition plan should, of course, include sectoral roadmaps aligned to Paris targets, disclosure of short, medium, and long-term targets on how a corporate is sort of reducing its emission. Also, we need more transparency on the implementation strategy, but and this then includes, of course, the budget which will be spent on the transition. But it's also important to address any sort of transition risks, climate risks in that transition plan, to report correspondingly also how is the transition journey going, and how far are carbon offsets used, for example, or carbon credits, and how is the whole governance implemented in the corporate. So this is something we consider important, and of course these transition plans should be also externally verified or audited, and somehow that we can then rely on this.
No, thank you very much indeed. Sean, how do you see it? I mean, you advise financial institutions. Are you seeing kind of similar trends in other financial institutions, building it into the governance process, building it into the risk management process in the way that Anne-Claire and Julia have just described? And what type of kind of questions do you raise with clients in supporting them in the development of maybe such a framework or process within their institutions?
Absolutely, it feeds across multiple functions, and it's really important then to have that strong overarching governance structure in place to make sure that, let's say, the KPIs that might be set under a sustainable finance framework for an SLL, and that they're challenging, that they're right-sized in terms of sectorial decarbonisation pathways. And other factors that we would also look at with clients is in terms of the national climate plans. So again, different jurisdictions have different trajectories depending on the makeup of the industries within that geography. And then I think, other pieces that we would also look to consider is building out upon the investment case and the budget that the client presents is how is that linked back to executive performance. So, what does it mean if we don't hit a target? Who's responsible? How then is that adjudicated upon within the organization? Because it's very, very important. Easy set a target, but someone has to be responsible for it as well. So we go all the way down to the very granular level in terms of those kind of points to make sure that they're there and they're appropriately right-sized. And then bringing it back up then to see how does that fit with, let's say, the portfolio or the bank's own target. And of course, what might be of interest to some of your listeners is making sure what kind of capacity there's to do additional lending. So it's not just about the immediate, what headroom does that create? What if we're running ahead of plan? Does that mean that we can allow more time for maybe some of those more hard to abate sectors to have a more orderly type transition? And then, of course, we're starting to see through the regs, what are the wider factors just outside of climate? So what does that mean for nature and biodiversity? What role does that play? And of course, the social considerations as well, whether that's through the sustainable finance framework or through a different type of social metric. Also, because again, that information is becoming more and more important. And then we spend a lot of time with clients thinking through tactically where they need to get to in the next 3 to 5 years, and how, of course, the situation might evolve out in that. So we're always trying to build ahead and build with the client solutions that are reusable as we move forward. But again, we see a lot more work going into that sustainable finance framework now. We're looking also with a number of clients and we're seeing how do they bring it outside the corporate realm? How do they bring SMEs into focus? And again, to Julia's point, definitions are essential here. So again, definitions are something that the industry struggles with, that we do need some additional guidance on and help. And of course, making sure that that's appropriate for that sectorial decarbonisation pathway vis-a-vis the timelines and plans that are obviously put in place. And of course, I suppose the final thing then is tying that into the bank's own capital raising structure to make sure that you're creating those circular type transactions. And again, we've seen a number of institutions do that very, very well.
Actually, that's an important point you raise on green bonds and other structures for actual capital raising by the financial institutions. But one follow-up question, to what extent is this driven in your clients from your perspective by the company's own strategic decision-making, or to what extent is it seen still as a compliance exercise because legislation is requiring it? To what extent is it, let's say, supervisory expectations or modern expectations, the threat of a stick? And to what extent is it kind of thinking through internal risk management for the medium term for the company in itself?
So it's an excellent question. So I think it's the same coin. They're just two sides of it. I think a lot of institutions started off in terms of meeting the regulatory expectations. Climate is systemic risk. So that was a starting point for many. However, what has been noticeable is those organizations who are now realizing the commercial opportunity have taken a slightly different approach. And they're making it, and they see it as an investment case, not a compliance cost case. And again, what they're doing now is looking at it through a different lens, and we see a different approach. But again, what we find very, very interesting about that is the revenue line that's potentially available, and how an adjusted return on equity might look. And maybe more importantly, how their engagement scores with our customers are going in a positive direction. And how, of course, over the next 10 to 20 years, that they're able to build out their own balance sheet in a much more resilient manner. So I think you're seeing a change in thought process, where what may have been a compliance-led exercise 4 years ago or so, now is becoming a commercial exercise. And I think that commercial imperative is really, really important. However, as everyone on the call can probably appreciate, there are constraints, whether it be data, definitions, and so forth. And that creates bottlenecks. But again, we're seeing clients work through that in a very diligent way, because again, the opportunity now is becoming so apparent that from a shareholder perspective, they need to deploy more assets towards it to make sure that they're in market leading positions as we move towards 2030 and obviously the inevitable targets.
Sean raised an interesting point, which actually segues into my next question to you, Julia and Claire, which is, how is the relationship with your clients changing as a result of this? Because it's not just you taking data and taking decisions. Every client relationship is a relationship, it's a dialogue. How do you see that emerging, Julia? that interaction with the client, working with the client, bring them along, they bring you along, you both learning at the same time.
No, absolutely. I think sustainability is already a part of the client dialogue. Here we are sort of will focus this more and more also in the future with regard to transition plans. And I think they're very important. And I think it was said also on the corporate panel this morning, we are together in this transition journey. So it's not only about receiving data, it's about also understanding and listening. And to be able to support. But I think it's not only about the banks and the corporates. I think we all need to work together here, together with the regulators, to make it work, because I think there's on the one hand side the expectation from the regulator and then maybe from the banks. But I think it's very important that our clients, when needed, get the sufficient flexibility to sort of achieve their transition targets, especially also looking at small and medium enterprises, which are so highly relevant for the economy, but which will need our support here too. And we cannot sort of have the same set of criteria compared to a large corporate, for example.
And Claire, does that match your experience as well?
Yes, exactly. And we can see that there is of course, sustainability was already part of the discussion we have with our clients. We can see now that there is a more and more focus on the regulatory side. We have a lot of meetings in which we are intervening to explain our vision and the impact of the regulatory package for us. From both perspectives, from a fund provider, but also as a preparer. So I think it strengthens the relationship we can have with the clients. And I think also what we can see from those discussions is that is more or less the question you were raising, is how are we going to organize, to use this information. And I think it raises also a more wider one, which is how can we share the responsibility of it? And this is something also which is quite important, I think, in the definition of the transition plan. And in the link with what Julia was mentioning, that we are all in the same boat. It's not only us and the corporate, it's also the regulators and I would say the commitment the EU has taken. And this is the final goal. And I think in this goal, what will be key to achieve it is also to make a clear set of responsibility in it, meaning we clearly have the role to support this transition. So that this is why we need those definitions, taxonomy being one, and of course needed to be completed by a transition. And this is already, I think, well tackled at the corporate level, but we might need more policy perspective, meaning where are we expecting the economy to be? Because at the end, we are not only financing one corporate, but many clients. And I think there is a lot of question related to this perspective. And at the end, something that is very key also for us with our clients is to explain them that to draw the line between the transition and the need to support it, and the need also to understand that at this stage, climate change is not a risk per se. It's one of the drivers of the risk, but it's not. If we are to fund this transition, we must all find a good balance between having the tool to identify this transition and not anticipate too much the risk, or not to put too much pressure on this side. Otherwise, it will slow down the transition financing. So there is really this good balance, this between responsibility, risk, and being able to have a good definition supported by policies, by sectorial policies, I would say, or sectorial targets.
I think what you say very much mirrors what we heard in the corporate panel, which I think was, as you say, it needs to be carefully calibrated, it needs to be sensical, and the data provided needs to be relevant and purposeful, because otherwise it's a lot of costs and compliance at a time where the macroeconomic circumstances and geopolitical circumstances are not necessarily favorable for the economy, let's put it like that. I would like to close with one quick set of questions, 2 questions, and a short reaction from each of you. One is, do you feel, kind of as Sean said, that the capacity for additional finance or the return on equity are being influenced by sustainable finance? So are we seeing some form of green dividend or first green shoots of a green dividend? And the second one is, if you had one wish free for the European Commission, wherever they might sit, whichever DG it is, what would that be? And maybe, Sean, I start with you.
Sure. Well, I think I can start with the wish. And I think when I talk to clients on behalf of clients, it's the whole issue of clarity and definition. It's ambiguity causes issues. It slows everything down. If we have clarity, and then maybe finally, the public-private partnership is extremely important. Again, you can't deploy capital unless the infrastructure is in place to put that capital to work. So again, that's another key component element. So I think from a Commission perspective, it can give the clarity, the definition, and of course encourage then national governments to play their role. I think that'll be extremely beneficial.
Well taken, because in many of our previous sessions, there was also a point about there not being enough green projects, not enough clarity around what is green on the ground for financial institutions to take decisions, and also not enough communication between supervisors and financial institutions as to their respective expectations within certain timeframes. Julia?
Yeah, no, thank you, Nick. I think regulation is only one way how to incentivize sustainable finance growth. And I think we sort of welcome very much the EU response to the Inflation Reduction Act in the USA for earlier this year, when the Green Deal Industrial Plan was announced. On the one hand side, with a complex set of measures, but providing subsidies both on EU and national level to green technologies, and also simplify the whole administrative process. I think that's very important to make process, and I think here progress. And I think here it's not only EU level is critical, national level is equally important, because a lot of this relating to energy policy needs to be solved at the national level as well. And looking at the EU and the policymakers, I think I have one wish going forward. I think we need to work together here with the industry and the regulators and the bank to define what is a good transition plan so that we are in a position to accelerate further transition finance.
Thank you. And finally, Anne-Claire.
Yes, I would sum up what Sean and Julia said with alignment. I think what is really key is now that we have, I would say, a first framework, a first reporting framework, which is quite consistent. It's really important that we put it in the good order, and that we make sure that not only financial supervisor, financial market supervisor, but also national authority with our energy policies, for instance, but also interoperability and promoting non-European standards or transition plan definition and so on. So make sure that the whole framework is aligned and support this transparency and this transition funding, not putting too much pressure yet on the bank before this framework is actually usable. And on your green dividend question, I think it is totally linked. I mean, I think it is the aim at the end. We are not yet there, to be honest, but if we take the time, if we have not only reporting but also monitoring tools, underlying pathways, I think we are going very fast. So we are on the good pathway.
Yeah, I think echoing what Sean said earlier, it's only been a journey of a few years, and we're still putting many of the components together. And you ultimately have to take your decisions on investments and provision of credit on a sound basis. And while we're there, we're not quite there yet. So in a way, your response does not fully surprise me. But it'd be interesting if we do this in a few years' time, what the answer would be to that question. I think with that, a big thank you. By the way, another theme that you did raise and I didn't go into, which was the international dimension and international consistency. I didn't do that I did do it deliberately, but for the reason that most likely the next seminar we will do will look more specifically at questions of international consistency once we've got more clarity in response to the current ISSB consultation as well on future work areas and so on and so forth. But a big thank you to you, Julia, to Anne-Claire, and to Sean to take us through that very interesting conversation. Really very much enjoyed it. And one of the policy responses that the Commission has come out with now is the proposal on sustainability ratings.